My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I just want to try to save you some money. My job is not just to entertain, but to educate, put it in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Signs. We're always looking for signs. Signs that the pain might be over.
The House of Pain.
Signs that the bear might be on its last leg. That there's been so much pain, it just has to end soon, right? Wrong. Just plain wrong. We are not sure when the beatdown's going to be over. But it's definitely not over when you get a day like yesterday, where our stocks roar because of something that happened in Britain, of all places, something that's nothing to do with the United States, because that's precisely how you get a horrible reversal like we had today.
Sell.
Dow lost 458 points. S&P dropped 2.11%, and the NASDAQ nosedived 2.84%. I don't want to be a bearer of bad news, but I also don't want you to get faked out again. It's kind of like my mantra here. I don't want you to lose a lot of money. So let me tell you what we need to see before you can actually be as excited as the buyers were yesterday. Now, first, I want to start on a positive note. If you buy stocks here, I actually think that you'll most likely make money a year from now. I say that because if you bought the most traded stocks the day before the crash of 1987, arguably the dumbest day in history to buy stocks, and then you held them for a year, you made good money. The market immediately got cut in half after you bought, and you still came out ahead after 12 months. To me, that cuts in favor of doing a little buying, like we did a little buying for my charitable trust. But I think you'll do okay, not great, right now. The market's oversold. There are a lot of good companies on the new low list. Eventually, owning them will work out. They'll do fine. But you could do even better by waiting for the right moment where things are a little more clear. What does that moment look like? Okay, for starters, you need to understand that this is a bear market. And each bear market is unhappy in its own way, to paraphrase Tolstoy. This bear market's dependent on the Federal Reserve. And the hawks on the Fed need to be appeased before it can end. That's just the way it is. That's the script. And that's why we need to anticipate exactly what the Fed wants, particularly the hawks on the Fed. Unfortunately, there's one word of what they really want. They want pain. Specifically, they want to stamp out wage growth. And that hasn't happened yet. They want people to stop making more money or even outright maybe even make less money. The Fed's making that happen by raising interest rates to the level where nobody wants to start a new business or expand an existing one. With higher rates, companies that need to raise money may not be able to get it. This morning, though, we learned that jobless claims hit a five-month low. After all this tightening, you'd think they'd be going the other way. That claims number was nothing short of a disaster. The opposite of what a bull would be looking for. No wonder Loretta Mester, the president of the Cleveland Fed, came on Squawk Box this morning. Steve Litzman interviewed her, and she sounded incredibly hardline about the need for more rate hikes. But that was only her first punch. It got worse. Later on in the day, she came out and said that even a recession won't stop the Fed from tightening. Even a recession. That may be the toughest talk I've ever heard from anyone in the Fed in 40 years. And believe me, I was alive and well when Paul Volcker was doing what he was doing. When you see low jobless claims after all they've done, it will most likely lead to another overheated employment number next week, which will cause still one more run-up in Treasury yields, something that's real bad for stocks. Mester is such a hawk that I don't know if she'll be appeased until we go to 5% unemployment, with food and wages both lower than they were pre-pandemic. I thought that that's exactly what she's saying. There will be others who hopefully aren't as hawkish from the Fed because she's a one-woman stock destroyer. But she speaks like her camp is in charge, and that is disconcerting. The Fed's not going to stop until we see more unemployment, which is why we need more high-profile layoffs. I know that sounds strange, but it's what we need. Sure, DocuSign's firing people. How could they not? Peloton is firing people, too. COVID play. Bed Bath & Beyond reported same-store sales down 28% in its flagship nameplate store, so of course they got to be firing people. But we need to see actually stronger companies doing the same thing. Well-run companies that simply don't have enough business. No, I'm not talking about the hiring freeze that Mark Zuckerberg announced at Meta. I'm talking about outright layoffs. We need to see it because that's what the hawks and the Fed want. They want bankruptcies. They want liquidations. You name it. And they want them from real big-name companies, not small-time tech outfits in Silicon Valley. If we're unlucky, the Fed will want to see stores in the mall going under. They want to see steel mills close. They want plastic companies going belly up. A whole litany of things. But notice I didn't say banks. The economy is so strong and the banks are so well capitalized that as rough as this moment is, I don't think it's going to be anything like 2007 and 2009. 2007, 2009, I'm calling that, you know what that was? That was cataclysmic. This is just incredibly nauseating. Here's one you can fix tomorrow. The Fed wants you off margin. Wants you off margin. You hear me? No more buying with borrowed money. And it wants speculation halted. Speculation is a sign that there's too much money out there, highly inflationary. So we have to watch all speculative assets and bet that they will be wiped out. Crypto's the poster child for speculation. So it needs to get crushed before the Fed will stop administering its tough medicine. Anybody who borrowed money to buy Bitcoin or Ethereum needs to be blown out of the water just to please these people. That's what the Fed wants. They also want the memesters to disappear because they, too, stand for speculative excess. A wipe out GameStop would probably make them happy. Apes, I told you not to buy that Bed Bath & Beyond last month, but you laughed at me. You made fun of me on Twitter, to which I say, sticks and stones may break my bones, but unread Twitter I posts never hurt me. Oh, and one more thing. NFTs, normally non-fungible tokens, but now something I can't say on TV that it stands for, they need to disappear, with anyone who buys them becoming closeless emperors. I like a lot of the people who own NFTs, but that doesn't mean anything. Good thing the NFT market is practically dead. At the same time, we need the help wanted signs to come down. They're still everywhere. You have to see many more lost or leased signs instead. I know these are not nice things that I am saying. Nobody wants a bad economy. I don't want you to get laid off. You don't want me to get laid off. But the Fed is going to make sure we have many, many, many more layoffs until they think inflation is under control. Eventually, people stop paying attention to their portfolios at all. It's all like the 5 stages of grief. We still have too much hope. We saw that yesterday. We need that stamped out to appease Mester and her compadres. Finally, the Fed wants to see homes sitting on the market a long time, not best and final bidding wars. The Fed wants housing prices, your house, go down in price. We have nothing like that, nothing at all. Rates may have to go up substantially to make that happen. These are stark. These are vicious. They are far beyond what people were expecting until recently. But this is an aggressive, concerned, rightfully concerned Fed. We've had a good run of it, wealth building, and now they are taking some back if you let them. Me? I wouldn't do it this way. I think they should be more measured. I think they should be more prudent. I think they should take their time. They're beating inflation in so many places. Unfortunately, they're not winning on food, they're not winning on housing, and they're not winning on wages. And they need to hit that trifecta before this will end. Of course, Loretta Mester is on the extremely hawkish side. She was talking tough in 2018, too, right before the Fed pivoted and turned dovish. It could happen again. But for now, we're still waiting for these negatives to show up in the real economy before the Fed can declare victory. It's going to be difficult. That's the bad news. The good news, the Fed wants to get this done real fast and real quick, and I think they will. It'll be more like the brief bear market of '87 than the financial crisis of 2007, 2009. And there will be intervals where it looks better. There are stocks right now that are too cheap to ignore if you take a longer-term view. Plus, a lot of damage has already been done. You're not coming in at the high, right? We've got so many stocks of companies with healthy balance sheets and good dividends, and you have my blessing to buy them. We talk about them all the time. We talk about them with the CNBC Investing Club. But the bottom line, until housing, food, and wages go down, this market's taking its cue from that great investment legend, Mr. T, as Clubber Lang in Rocky III. When asked what he was going to bring to Rocky Balboa, he said one word: pain!
The House of Pain.
Lloyd, New York. Lloyd.
Hi, Jim. Thanks for taking my call.
Of course, Lloyd, what's up?
My wife and I recently inherited Papa John's stock. What are your thoughts?
Okay, the restaurant business is a lousy business right now, a terrible business. I know that more than most. Costs are going up still, and you can't contain them. So I'm going to have to say, even though I like that company very much, you do not want to own it. I'm sure your basis is very low, but I have to tell the truth. You don't want to own that kind of stock right now. Uh-oh. Richard in Pennsylvania. Richard!
Jimmy, how you doing?
I'm having a long day, but it's okay because we're all in this together. I'm looking at my executive producer. She knows I try every day to bring it. I'm bringing it again. How can I help?
So I have noticed that the banks are reluctant to raise their deposit rates, CD rates. do you think the banks are going to raise them, and are they going to make more money on net interest margin? My question is for Bank of America.
Okay, I was doing this yesterday. I was doing the work on Wells Fargo because we own it for the charitable trust. And I have to tell you, I know that it's de rigueur to say this, but I think the banks could be the leaders coming into the next cycle. Why do I say that? Because they are going to pay you very little on your interest on your balance account, and they're going to make a lot of money. It's going to be very much like 91, 92. I cannot believe that I'm old enough to remember that. Most people who are watching 91, they may not even been born, but let me tell you, that was some great time for buying banks. Let's go to James in Washington. James!
Booyah, Jim. I'd like your opinion.
Booyah, James.
In this market, is my stock a buy, sell, or hold? My stock is Generac, GNRC.
Okay, I think our grid is so horrible, and I think the inventions that Generac's doing are so good that I actually like the stock here. It's down 50% for the year. I think if I wanted to buy 100 shares, I'd buy 25 here, and then every 20 points down, I'd buy more. So you say, well, why don't I wait till it's down all the way? Because it may not get there. I think it's a very interesting company for this time. I like it. Now, if we're talking about stocks with healthy balance sheets, you have my blessing to buy small, just like we're doing for the CNBC Investing Club. I think it's too late to sell. But until housing, food, and wages go down, well, let me tell you, the market's bringing you one thing. It's Clubber Lang's pain. Man, money tonight. Morgan Stanley, an Investing Club stock favorite, has a key thing going for it, and it's incredible leadership. So tonight we're checking in with James Gorman to discuss everything from volatility to the bond market to your money. Then the used car cohort has collapsed ever since it peaked last summer. So is there still room for the sector to cruise higher, or has the opportunity come and gone? You can tell what I think. I'm taking a close look at the space. And yesterday's bounce had investors hopeful for what's to come. But today's tape told a completely different story. I'm breaking down exactly what happened and how negative it was about what occurred yesterday. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.